Another day, another set of headlines shaping the global economy. From new IMF projections to rising trade tensions with China and shifts in U.S. monetary policy, this week revealed how fragile yet interconnected the world economy has become. The big question, are we heading toward a soft landing or setting up the next economic shock? Let's break it down. Part 1. The Global Outlook, Optimism with a Warning. According to a new report from the International Monetary Fund, global growth is now expected to reach 3.2% in 2025, slightly higher than previous forecasts. The IMF cites easing tariffs and more stable supply chains as reasons for optimism.
News is that the growth downgrade is at the modest end of the range, with growth projected at 3.2% this year and 3.1% next year, while inflation has increased modestly and is proving more persistent. Now, what explains this modest impact? First and foremost, the tariff shock itself is smaller than initially feared, with many trade deals and exemptions. Most countries also refrained from retaliation, keeping the trading system open, and the private sector proved agile, front-loading imports and rerouting supply chains.
But beneath that optimism lies a clear warning. Renewed U.S.-China trade tensions could quickly reverse those gains. The fund cautioned that even modest tariff escalation could shave half a percentage point off global growth. Meanwhile, a separate Financial Times analysis highlights how America's AI boom, especially in productivity and automation, is cushioning the economy from a deeper slowdown. That means GDP is still rising, even as job creation starts to weaken. So while the numbers look good on paper, economists are asking a deeper question. Can growth driven by automation sustain prosperity for everyone?
It was the internet then, it is AI now. We're seeing surging valuations, booming investment, and strong consumption on the back of solid capital gains. The risk is that with stronger investment and consumption, a tighter monetary policy will be needed to contain price pressures. This is what happened in the late 1990s. There's also the flip side of the boom. Markets could reprice sharply. This would reduce wealth, consumption, and investment, lower activity, and could spill over to broader financial conditions.
Part 2. The Fed's Dilemma, Growth Without Jobs. At the Federal Reserve, Chair Jerome Powell said this week that the recent slowdown in hiring shows underlying vulnerabilities in the labor market. He suggested that the Fed may consider further rate cuts if the trend continues.
Too quickly, then we may leave the inflation job unfinished and have to come back later and finish it. And if we move too slowly, there may be unnecessary losses, painful losses in the employment market. So we're in the difficult situation of balancing those two.
But a new Goldman Sachs report warns that the U.S. might be entering what they call a jobless growth phase, where AI-driven productivity boosts GDP, but doesn't translate into jobs or wage gains. That creates a paradox. The economy grows, markets rise, and yet millions feel left behind. Sound familiar? It's the same pattern that fueled inequality and political unrest in the past decade, now returning, supercharged by technology. Part 3. Trade tensions. China's move. America's response. While central banks debate rates, trade tensions are heating up again. Beijing just announced sanctions against 5 U.S. subsidiaries of South Korea's Hanwha Ocean, after Washington opened a probe into Chinese export practices. At the same time, U.S. Treasury Secretary Scott Bessent accused China of weaponizing its control over key materials, especially those vital for AI chips and green tech. He warned that this strategy could destabilize global markets if left unchecked. The backdrop: the Trump administration's 100% tariff threats on Chinese imports remain on the table. And according to the IMF, a full trade escalation could knock $1 trillion off global output by 2026. Meanwhile, JP Chase announced a $10 billion investment plan focused on American companies tied to national security, semiconductors, defense, and advanced manufacturing. That's not just finance, it's strategy. Private capital is now part of America's industrial defense. Part 4. Energy, AI, and the new economic order. As trade lines harden, technology becomes the new battlefield. AI and data infrastructure now define economic power, and that requires energy. Both the US and China are racing to expand data center capacity with enormous energy demands. The risk: If the U.S. grid doesn't scale fast enough, the AI boom could stall under its own weight, just as tariffs and inflation pressures rise. Add to that the growing fragmentation of supply chains and the slowdown in foreign investment, and the path ahead looks increasingly complex. Yet the opportunity is equally large. AI, automation, and clean energy could spark a new productivity wave if America can balance innovation with fiscal discipline. Part 5. The American Challenge. It all connects. The IMF's optimism, Powell's caution, Beijing's retaliation, and Wall Street's repositioning, all part of the same equation. America stands at a crossroads. If it manages inflation, secures supply chains, and retrains its workforce, it could lead the next economic era. If not, the same debt, inequality, and global tension could trigger another crisis. The American dream has always relied on two pillars, opportunity and confidence. But confidence fades when policy feels chaotic, and opportunity narrows when growth leaves workers behind. Closing thoughts. So here's the real question. Will this new cycle of tariffs, tech, and tightening lead to renewal or relapse? Can AI and trade realignment create shared prosperity, or will it widen the divide? What do you think? Share your thoughts in the comments. And follow for the next videos!